Greetings, market rebels. Welcome to this week's macro measure. It's actually Friday, the 20th of October, 2023, and it's just about 6 p.m. here on the East Coast. I'm traveling this week, so this will be a little bit different because I will probably be traveling home sometime on Sunday morning when I normally would be recording these videos. I don't know if I'll get to sector situation, but here we are with macro measure. So let's get going on that. We'll talk about what happened this week and what we think may matter coming up. Here's the trustee disclaimer. Excuse me. Here is our trustee intellectual property rights notice. Here is this week's stream that I'll be trying to work my way through. And again, probably a little shorter than usual because I only have tri-screen set up here with my laptop. And it's tough to keep track of everything, a little funky here. But doing the best we can. Got the macro measure stream for the week. And then here's last week's if you'd like to compare it and just, again, see what's changed and where we're coming from last week and where we are this week. A lot of it's similar, but of course it changes from week to week depending on how things unfold and play out. So here we are going back here again. If you want to pause the video and just get a screen cap or something, that way you can sort of follow along, because I don't necessarily cover all this in this order, but I try to a certain extent. So right now I'm just going to stop the share and I'm going to reposition things a little bit and mainly get the PowerPoint over to the side and out of my way so that it doesn't affect the video all that much. And that way I can still track along with it. And then I will bring up, I think what I'll do first is bring up our tabs and our discussion. We'll get into our discussion with that. So let me get things shared again. It's a little different because I'm on this laptop. And I think just my main screen number 1 should do it. I think we're that screen 1 there. And hopefully this will show up properly. Yep, so that's there. So I'm just going to be able to flash a couple things in here on these tabs. And I think I wanted to, that's not it. Oh yeah, so this is actually UOA Pro. What I really wanted was UOA Elite. So the review and summary goes like this, right? Last week we had said that we thought the market was chock full of risks, which seemed to be building. And we thought that some of those started to confirm some of the market's technical developments last week were kind of confirming that risks were building. We said that this phase that we were approaching, the mid to late OC, it tends to be a concerning phase, and that we could be heading back towards the danger zone, meaning the recent lows in the SPY, which were near the 200 SMA. And then we also noted that certain sector developments and the Magnificent Seven were concerning, right? So we saw a little bit of problems creeping up there, and we noted that there were concerning surges in TNX and DXY, and that could continue. If it did, right, that would potentially be problematic. We also noted that some of the sectors could be starting to lose their luster, and we noted that the Magnificent Seven could be losing its luster a little bit, just the sheer little bit of a hint of it. We thought that the dollar DXY on Thinkorswim and TNX yields really were still remain the watch. We thought a test of the 200 and the SPY could be coming due to the weak rally attempt. So let me just try to flash that really quickly. I've got to grab the right, the right charts on here. That's not easy because I'm really bunched up. But I'll go back to SPY and we'll take a look at that so you know what I'm talking about on that chart. And that was our sort of inference that we were a little concerned that when they had the shot the prior week, so I'll put the line at really the dividing line between last week and this week, and they had the shot to go up here and close this gap and really try to come up to the 50 and 100. We said, that was a little concerning that they were not able to do that. That you would normally expect to see that if the bulls were really still the boss, right, to some degree. And they do have the long-term. We did note they had the long-term trends really still in their favor, because you can see a lot of these longer-term SMAs, the white 100, the rust-colored 150 and the purple colored 200, they were still all uptrending. So they still had that, the way a lot of people would look at it, they saw the long-term trend in their favor. They really weren't able to do that. So that was a little bit, I think, of a hint that maybe some of our economic concerns and especially concerns about yields were going to maybe, if they did continue to perk up, which they did this week, this could be a problem. And that's really exactly what happened. Really, we got that return to the danger zone. And I think it was really largely the result of what happened with yields again. So it's been pretty darn inverse. It doesn't really operate on a tick for tick basis, excuse me. Sometimes you got to wait it out, and they can play a lot of games while you're waiting it out. So again, it's not easy, but this did kind of play out the way we thought, where that 200 could become tested again, and these lows could become tested again. And that's where we are. And right now, I'd say there's a little bit for all, right? Where you could say, well, this looks horrible. And I think it does. I mean, the way the week ended, it does look horrible. But remember, there's been a lot of Fridays, we've talked about this, there's been a lot of Fridays where there's just no memory on a Monday. And someone in the cocktail hour raised the point that they think that lately, of course, that's due to the lack of war escalation that folks are anticipating over a weekend. And I think there's some truth to that, but this Friday into Monday with no memory thing, I think has been going on since before this Middle East situation erupted. So it's a good point that they raised, and I agree with it. But I think this, just to me, this used to be something that you could bank on more. Where, in my opinion, if the market was having a rough Friday, there would normally be a rough Monday, at least to start, and then after that, you could wait and see what developed. But who knows what comes your way from that point on. But usually there was a decent follow through, but that doesn't really seem to carry over as much as it once did. Maybe that's just a function of time being spread up and information disseminated so quickly. And so people that really want to sell, that are active, sell on Fridays, as opposed to getting the news that the market finished poorly and they sell on Monday. Anyway, why I'm saying there's an argument to be made is you're on the lower Bollinger Band there in light green with the dotted green, kind of Kelly green color. And you're also seeing a positive divergence potentially if it holds here. And let's face it, these guys are really great at slightly exceeding some ugly closes or lows like they did today, slightly exceeding maybe the lower Bollinger, slightly exceeding the 200 SMA there in purple, and then reversing things, especially because the market is largely bombed out. I mean, we've seen worse, but it's pretty sold under the surface. There's a lot of really rough looking stuff under the surface of this market. So with maybe the chance for, if things do not erupt further over the weekend, and then you've got these mega caps, super mega caps, and others reporting, maybe they can use the cover story, right? And this is how they spin things. Well, these were wonderful earnings, and it wasn't as cataclysmic or apocalyptic as we expected it to be on the conference call. All is well, and you get a short squeeze, right? So you can't really be. This is why this is such a tough call right now, because you can't be surprised how many times they've saved the market and squeezed it, despite yields just continuing to go up. That having spillover in the real world economy, and yet these guys continue to whistle past the graveyard, as we say. So it is what it is. I mean, this happens a lot, and we have to contend with this over and over again over the years, the decades. But what I do in a situation like this, if I did see a breakdown and I was sort of riding things fairly well, I would take profits on half. So I have this on cocktail hour. I would then overroll the other half to slightly out of the monies, right? So instead of being at my normal place where I get in, usually if I can, have my druthers, get in slightly in the money is my preferred option to trade with. And then if I'm right for a couple of bucks, I'm getting due to gamma in the near term, I'm getting a nice payoff near 80 delta. And I got in on the dollar cheap. I didn't have to lay out nearly as much to acquire 80 delta from the start. And I'm okay with that. So I do, that's just, everybody finds their spot that they like. That's where Ryan and I tend to be. And then, in a situation like this, when you've had such a steep fall over the last 4 sessions from the high, I would then say, look, it's been a pretty good drop. I do think there's probably more downside here, in my opinion, or there, at least there should be. And I do think there probably will be, but it's not super strong lean. And that's why I would take half off, capture all that money fully, and then overroll to maybe like 45 or 40 delta puts at this point in whatever I'm in. The whole situation took a turn for the worse. So let's show that, and I'll talk about that more whenever I record sector situation. But let me just try to bring that up and tell you why I would stay in right now. And that's really because if you can look at this column over here, and I'll bring these up more. I don't know why that's giving me so much space there. I don't really want that, especially because I'm on the smaller laptop compared to my normal 43-inch screen. So this is really tough. I hope you all can see this. I can't really know, but mainly, right, XLA, I always say this is its own thing, and it has its own unique, right, sets of risks, characteristics, and of course, geopol, and so many things come into play there. But they did take profits on that, right? They'd had a very nice, really 2-week surge overall, kind of came up to resistance, stalled, and they took profits here today. So that's not the end of the world on that yet, but I'm just saying that they even sold something that seemingly, if you look at the fundamentals, just as a layman, it seems like as a layman, this thing should have a bid and should hopefully, well, actually shouldn't say hopefully, it should continue higher. Hopefully it won't for consumers and for geopolitical risk factors, and of course the humanitarian side of it, which you can't, I don't think overstate. That seems to get lost in the shuffle, but that's my take on it. But XLK, XLC, these were the ones really that I'm talking about, along with SMH, that you can see they kind of finished right ugly. And they did put in, right, they tried to break out, failed here recently above this high in XLC. This didn't even get that far, you know, so you have a lower high that gets put in. So this is getting a lot more dicey. And then we could add to that the SMH, which I'll go back to, and we'll take a look at that. And this is really, like, this is staring you in the face. It's almost scary how much downside it looks like it has. And when it's this obvious, it just worries me. But when you have this kind of island gap that's just been really, it's been so reluctant to want to just fall off. It looked like it was really in trouble a couple of times, and excuse me, they just haven't let it fall. But this does look like the potential to me, with everything, all these sort of important sectors finally giving up the ghost. I've been waiting for that. They haven't given it up completely, obviously, but if they start to really give it up, that could be the end, where the people that are hanging on, that I would call premature bulls, that bought into everything's wonderful and there's a brand new bull market, and there still could be, I'm not even saying that, but right now they have to be feeling the heat, because there was all this talk of rates being lower sooner rather than higher for longer. And that's completely, and I do mean completely, blown up in their face. Now, I don't know if they were speaking genuinely or that was just the cover story to pump like they always do. Can't really say, only that they and God know. But honestly, I've seen it too many times. I'm pretty cynical about it. And I don't know if they really believed it. But again, each person has their own unique take and their own setup on that. Having said that, this to me, right, breaking down below the rising 100 day there in dash white, now you're maybe losing the 150 SMA. That only leaves the 200. We've been watching this for some time, saying, excuse me, this is a big deal, right? This is the sector that's really responsible for the maybe mirage of a bull market that unfolded from October of last year through July, the end of July of this year. So that's that. That certainly has downside potential. There's a gap here that's just glaring. Everyone and their grandmother and their brother and the horse they rode in on is probably waiting for that to close, which makes it tough. But we've been eyeing that up for a very long time. Of course, the lead sled dog there is NVIDIA, and it, excuse me, finally succumbed. I'm a little disappointed because a lot of folks do not like bidirectional UOA ideas. And I think in this market, you've got to be willing to be more open to that. I was really contemplating putting a bull and a bear because we had ostensibly bullish paper in this, and I think Microsoft and maybe AMD, few others early in the week, and that call buying to me, I had a really strong suspicion it was a hedge, but by the time, right, this is what happens quite often. People hear me say that quite often, right? If I don't put that sort of companion bear idea in along with that bull at the time, then I get swamped by other UOA that I'm evaluating as the week wears on. And before I know it, I look up, and of course, a big mover like this can move dramatically. And then it's sort of like, the trying to put an idea in when the stock has already dropped $20 is not nearly as appealing. So that's one of the things that's tough about it. And that's why I often do put companion ideas in, bull and bear, and that doesn't really sit well with a lot of people. But, I think we have to kind of get back to being really aggressive about getting those in more and more in both directions, because there's no reason. I think if you don't like that, just ignore the side you don't like, if you are in the UOA Pro service, because right during a market that's been up and down, right, these kind of volatile phases, it's hard to really predict and have high confidence as to what they're exactly doing. I think the real signal is they're doing something fairly big now, and it's near-term oriented, and it's in something that moves quite a bit, and that could come under pressure. And I think you just have to be open-minded that could be a hedge. And there's a lot of hedges, and we see a lot of put buying happen right before lows get put in, right, too. And we have to just acknowledge that when we're not in a strong bull, it gets a little tougher, right, to be very opinionated about this stuff. So that's where I come in at or arrive at in the end. So having said that, right, obviously SMH has trouble, NVDA could have trouble. These are your big areas we've been waiting on. And then I'll do this because we're here, and I was going to do this in a different order, but this is why I call it the stream, because one thing leads to another, and here I am kind of talking about charts, and as opposed to the points that I plan to cover. But we'll get back to everything. It's not as if we're going to skip everything. We're still going to cover it all. But if you look at this package, this is what we were talking about last week. We thought we saw some concerning signs here a little bit that this tried to break out and then couldn't do it. And that turned out to be a good little hint, I think, as well. And you could see that this Magnificent Seven package came under pretty serious pressure. And that's what I've been waiting for. I think anyone that watches the videos each week or regularly, I should say, knows that this is something we've been waiting for, the final sign that we could be on the verge of. That's when you really get that sort of cascade selling phase that appears eventually. So if this breaks down further from here, rates keep screaming, maybe that war causes it, maybe war escalation causes it. I don't know. It's the world to me is right now is about as complicated as I can remember, geopolitically and economically, and of course all that stuff's intertwined. But there you go in terms of that look. So this is what I used on Cocktail Hour. Please, if you are new, this is why we tell you, let's say this didn't happen, okay, but I'm using this example. Let's say we had a breakout above this high on that day, right there on that particular candle. That's about 1814.82. And then it goes up through and closes above there at 1840, closes at 18, what am I looking at? Oh yeah, it's 1814.82. It closes at 1817.76. You think it's a breakout, you decide to get in and hold, and you get a little bit of follow through and it trades up. Well, again, if you didn't do a quick trim, you didn't do a quick trim and a roll, you didn't do anything, you just wait, this is exactly why you have to get back out if it comes back below our trigger. Because if it gets below the trigger, that really is a possible false breakout. And false breakouts, in some people's minds, they prefer, and I do mean like technical people, they prefer to trade false breakouts over the real ones. So just keep that in mind, because that's telling you, right, that they love that signal for a reason. And that's telling you that the things that do deliver false breakouts can reverse sharply, which this did and many other things did. this is why the discipline has to be there. With if you don't do these quick trims and other smaller things that I advocate, that's fine if you don't like handling them that way. Everyone's got their own approach, but please do not play play games with trigger management. You just can't do that, especially in a market that's as fraught with risks as this one. So that's my little soapbox of trying to help out people, especially the folks that are new. So let's get back to the fact that we'll go back to SPY, and we did think, right, that let's get the other tab up, and then I'll come back to that. So where are we on tabs? That's not it. This is it. So what I wanted to show really quickly before I get into that comment is just want to show you a little bit of scrolling here on UOA Elite, which is where John and Pete and myself, our team that's in there, our analysts, they're checking everything that Heat Seeker's picking up and trying to make the best sense of it as they can, excuse me. And you can see that there's a lot more sort of red than green entries that went in today, I should say. And even yesterday, right, the ratio of red to green is a little more balanced. And so why this is important is because, right, you can see, look at all this red appearing. We normally see mostly call buying, right? We normally see predominantly bullish activity. So I would say that bullish activity is usually it's probably somewhere around 70-30. And during a bull market that's super strong, you might even see it at 9-to-1 ratio. So I've seen days where we've had in a roaring bull phase, nearly 70 hits with maybe like 3 of them, 2 to 3 of them being a bear. And there's even been other times where it's been maybe like 50 hits where you had maybe 50 hits and maybe one of them was a bear on the bear side. And you get a couple days like that in a row, and that's where I'm coming up with this 9-to-1. You get a couple of days like that in a row, and you're like, wow, this is incredible. And usually those call buys are pretty strong to follow as well from my experience. But we have seen a lot more put buying. So what that tells me is that there's a lot of hedging going on because people are getting really worried, or there's a lot of downside speculation because people see the technical break potential that we do, or there's a lot of people that think that this thing's ran its course. We're going to hold here. Earnings maybe are going to be used next week and maybe the anticipation of the Fed sitting tight in about 11 days from now. All that's going to produce this sort of surprise rally that's going to get a lot of people caught off guard, and they're just buying a lot of puts because they're loading up on stock at these, let's say, depressed levels relative to where they were. So make of it what you will, but I did want to share that with everyone. Getting back to, excuse me, SPY. I'm up in the Blue Ridge Mountains, and it's a little cool up here, and I got a little air, and excuse me, it's wonderful, but it just kind of getting me a little bit at the moment. I've got to get used to it. So so I wanted to get back to the SPY. Come on, where am I? There it is. Okay, so here's my SPY. So this is what I wanted to take a look at, which is right here's Monday's action there. And you can see that we closed down here on Friday, and they opened right up strongly and just pushed from that point on practically. So there was no memory there. But again, this is on Tuesday, they had another failure, right, where they tried to break things out, and they came right back and closed under that blue line we talked about last week. That's my bull market support line. And so that goes all the way back to the October lows. I'm not going to belabor that because we've covered it week after week recently. And that to me has relevance. That's anchored on some really good points. And it tried to get back into bull market mode and just failed. And then you went into heavy retreat. And of course, I think that's really due to the things we've been saying to watch. And I do kind of feel a little bit like broken recordish, but I've got to, right? That's just the way the market's been. I've been saying this for really since the early part of 2022, what I thought was going to happen with rates and how this would eventually become a problem. And right, it just become more of a flashpoint or important watch as time has wore on. I just don't, and my simple take on things is I just don't think that all the debt that's out there can be supported, and the economy can be supported since it's so debt dependent when rates become as restrictive in terms of consumption, et cetera, as they have become. And so you combine that with super high prices, I think it's really a double whammy. I think wages have lagged. I don't care about the average raise that people have gotten. It's definitely trailed inflation, and that's not even real inflation. That's the bogus inflation that the government puts out decade after decade, and people just somehow go along with it. But you would think that we could all at least agree that we should be talking about real numbers rather than fictitious ones. But that's not what people demand at this point, and still at this late hour. Anyway, TNX, you can see how much that surged. And of course, that's what we've been saying, right? Every time you can pretty much overlay this and you're going to have an inverse relationship. So yields moving up, the dollar just doesn't help right when the dollar stays strong for stocks. And it didn't really have an interesting week overall, but it didn't really give much back. So we'll see what happens if there's going to be that panic to get in the dollar. But the other thing we should mention while we're here is the VIX. And the VIX is really, I think, maybe on the launch pad, finally. And so you got to keep an eye on that one for sure at this point. I thought Brian McCormick did a great job with the videos he recorded for Cocktail Hour today, and that we showed at the top of Cocktail Hour. If you didn't catch it, it might be worth a watch. But for you, I don't know. I think it is. Anyway, this was, this really has the makings now of one of those kind of surges up to the upper 20s, lower 30s to me at this point. Now, excuse me, what could, of course, undermine that would be the EPS releases that will be, we will publish on, I think, Sunday. And of course, a lot of that stuff will make its way into newsletters and so on and so forth. But the market outlook should have all that in there. But this is really there now, where you kind of get this gradual working up, and then eventually there's a spike. It seems like it's really close to that to me. So we'll see, right? You just don't know what Monday can bring. So let's get back to our tabs, and I'll start making sure I've covered everything. I know I kind of went in a different direction there, but we will come back to where we really needed to be. And let me see if I can just slide this over a little bit. That's good. Okay, so what I wanted to show here in Rebel Pit Pro is this part of the year. And you can see that, again, it doesn't really matter if it's the pre-election year for in the presidential cycle, like we're in now, the third year. Really, most years are rough, but overall, you could see that the all pre-election years are the black line, and the green line at the top is this particular that's first term pre-election year. We probably should focus on the black line here, actually. But on this one here, right, you can see that this pre-election year tends to have a rough second half of OCC. So we're coming up to that. Maybe, after we get through, if there is a rough week that comes up, maybe we do start to see a bottoming at that point. That does seem to be a bottoming point for the balance of the year, with the Fed coming up and probably sitting still. The probabilities are right here, as a matter of fact. Right here is the November probabilities, and there's even a slight tweak that a 4% chance that we go down from the current target rate. But overall, I think folks would be surprised if anything besides sitting still happened. You can see how many people, in terms of probability wise, are expecting that. 96 out of 100 expect things to sit tight. This is where it gets interesting, though. This has shifted a little bit, where there was very few people thinking there could be a cut. That's jumped up a little bit to 3% nearly. But the other thing that's interesting is that, right, you've decreased here, right? So the chances of going higher in December are now down from where they have been. And so interestingly, I think I said that last week or the past couple of weeks, maybe, that here's January, right? And then that's the other interesting thing to me is there's people that think, okay, they sit tight for this whole year, but then they go up again. Maybe in January, there's nearly a 30% chance that you go up by some extent from where you are right now between 5.25 and 5.50. So that's interesting, right? But there's also a little group that believes that maybe you go down by then. So it's gotten a little bit more of a wider distribution in terms of the probabilities. We'll see what happens, but honestly, I think that the Fed should sit tight myself. Even despite inflation being understated, it seems like the trends of inflation are down. I think it wouldn't hurt to just give it a month or two to see where things are, and maybe that way you don't really over tighten and then have to go into a retreat mode. But you have to. That kind of makes the assumption that they're reckless because they're not really competent. The way central planners tend to be not very competent, it doesn't make the assumption that they're actually reckless intentionally. So you'll get arguments from both sides, but I kind of side more with the reckless intentionally crowd the older I become. Anyway, here's the fear and greed index, really close now to extreme fear. And that's why there's risk right now for bears. They've got this stuff beaten down. They beat the bullishness out of 6% more of people this week. Here's AAII, right? So they beat the bullishness out of a decent chunk. The thing shifted a little bit. There's still not enough bears out there really, right, to form this super low. If you notice, right, you go back to last year when there was still a lot of bearishness and the market was rallying, at some point from October through July of this year. So that's kind of gives you that view of where you are there. So could you get more extreme? Certainly, but you're almost there right now. You've got this other situation with the sentiment kind of getting knocked down. I think it probably should. I do think, and I'm going to get back to the charts and my slides, but I do think that that's spreading, right? I do think that the fact that the market's showing this kind of failure potential has got to get these people nervous that even though it's other people's money, these professional fund guys, their performance could really be in trouble and at the end of this year if this whole bearish thing unfolds. And so that's the big question still really is, are we still in a new bull that's having a corrective phase after an amazing run, or did we just see really a very powerful rally inside of a larger bear market? So that's what's still in question. We've been talking about that for some time. I guess we still don't know the answer. So we don't know if there was a bull trap on this, or if bears got trapped and they're about to get the ones that have held on are about to really get skewered again, because they're going to try to put a nice little double bottom here and use again the aforementioned EPS, mega cap EPS and others, and use the Fed sitting still, if you will, to justify some rally, get some cover on the rally. So in a nutshell, right, the outcome is the VIX is on the launch pad. We saw that. The Magnificent Seven did finally get tattooed a little bit. We've been waiting for that to manifest. That is a sign, along with the other sectors that a lot of those companies are in, XLC and XLK, SMH, that those are now falling. That means that there's people getting more worried. They're taking some money off the table there for whatever reason, or they're panicking a little bit. The SPYs clearly closed at this critical level. This could be argued a couple of different ways. It's on its way down. I think if it were to come more in line with realities, it should be on its way down. I think a realistic target for this thing would probably be coming into this level right about here. So first and foremost, so I would put that at 417. So only 1% more down. But I think really your 400-ish, 400 to 404, that's going to be your big area of where this could get to if this really does become more of a risk-off situation. I think it goes back to near 400 on SPY. Let's take a look. So I would say, like, look, could you say that they double bottom this year and go? You have to allow for that. I don't think that's going to happen despite the earnings, but it could be some kind of just people are just way too over leveraged to the downside right now, and they are able to pull that off through the normal squeeze techniques that they use. And maybe the conference calls they speak of these big guys aren't feeling the bite because they're so far ahead of the rest of the pack. Don't know, just saying, just throwing a few ideas out there. I'd still be at DEFCON 1 though. I mean, you've got to be ready to play defense immediately, right? Or go on offense on the bear side, so like I said, I would, if I were riding things fairly well this week, I would have captured half, completely overrolled the other half. That's really where I would have been. So this is, again, it feels like you're at a cliffhanger. This is clearly a very critical area for a lot of reasons. And we just don't know if it's going to be the takedown that really finally comes, or it's going to be the jam job that they've pulled off so many times when, it looks like there's no reason even for someone to come in and start buying. They get things cycling back that in the upside direction. And then bears start slitting their own throats because bears have just been conditioned to do that because of all these rallies that that are manufactured. Again, that could all be off the table if the war escalates. But if the war does not escalate, then that might not bring about that big whoosh. In fact, it could again provide a bump on Monday, and then they could use that to keep things levitated above this low that's critical with EPS on deck. And then if you have good EPS shenanigans, right, then they're right at the Powell point, right? They're just a few days away from maybe Powell sitting tight and then using that as a cover for potential goosing. So I'm just throwing that out there. I think it should tell them the opposite, that if Powell's sitting tight, he's gotten worried, and that's a good thing ultimately, but it probably means worse things for the economy sooner than later, because that's where Powell's coming from. But we'll see. I mean, it's not an easy thing to gain. So I did mention that, right? We could see signs of bottoming as per that third year that we just saw, and we could see a squeeze, right? Courtesy of it could be squeeze time again, but certain factors have to fall in place. So this is in flux, and obviously you've got to keep your eye out for war escalation, and you've got to keep your eye out on these yields and the dollar. I still think that's where you should be focused in terms of if they're rallying, if those two are rallying, and that the threat of war remains imminent. It just, to me, is just not a good mix. I know that wars tend to be good for war suppliers and economies, but over the course of time. But I think the immediate reaction, kind of the early kind of next phase reaction, wouldn't seem to be good. Anyway, that's what I keep my eye on. We already talked about the back half of October. Stocks are on the precipice. As I said, per our view, I think we should plunge into risk off to bring things more in line with the economic prospects as I see them. But again, I'm not going to trade that. I'm going to do what I did. I'm going to just handle it prudently as I think I should, and to see what I can get out of it. And I can always, if I do see things getting worse and worse and the panic setting in, you can still, again, you can add from a different level, right? Add your puts from maybe a lower level. Maybe you didn't get the windfall, but you could still do really well. I still can't buy what they're selling out there. And that, to me, again, with the Jamie Dimon stuff last week, with the Paul Tudor Jones stuff last week, the wall of worry is in place, right? That's largely in place, if you ask me, because I think a lot of people see a lot of the things we've been discussing in the webinars, in this video, the other weekend video, the cocktail hours, all the market outlook stuff we do, right? The stuff we slip in here and there during the week, in the webinars. That, to me, we just keep finding more and more things that are concerning, and so I think people that are serious know all that, right? So not the perma bull crowd, not the perma bear crowd. I mean, people that are serious know all that too, and so I think so. Again, if you want a wall of worry, it would sure seem to be there. So we'll see. I do think, as I noted, the bulls or premature bulls are becoming more nervous. That's my take on it. That's what I think is unfolding here with this manifestation of selling in the darlings that they didn't want to touch up to this point in a strong way. I still think that many key factors, especially yields, remain unsupportive of the equity market going higher. I do think the jump the gun anxiety of last year's and the rally that began last year and continued through July, I think that's spreading across the herd a little bit. Like I said, know thy collar. Last week I said that. We said it in webinars this week. If you're new to this stuff, at least go and learn the collar so you can figuratively hit the pause button, as we call it. And then with much of the market oversold, if there is heavy selling, right? So you've got to be prepared for this too. If there is heavy selling, you've got to turn that rolling discipline knob up to 11 because you're already oversold. You do not know when they will step in to support this market. You do not know when news breaks about some wonderful development somewhere. It happens a lot. So if the worst thing that happens to you is you make a bunch of money by rolling and staying in it and don't get shredded when they take it back up, then that's not such a bad thing if they take it back up. But they've done it so many times, you've got to like balance it out, right? And just be very disciplined about it. But here's the cues. Let's just cover a couple more things. Here's the cues. You can see they're really close to that key technical breakdown level. There's just not a lot on the way down to the 200 at that point. You got the 150 coming in maybe at like 352-ish in the cues. But other than that, that thing, a test of the 200 just seems right to me at this point. We'll see. IWM's continued, again, interest rate sensitive, smaller companies. They need to borrow more, and you can see that's gotten wrecked. We renewed an idea at I think the trigger was somewhere in the 174 level this week to the downside. We already had one that was still in place, but I wanted to put something newer so folks that recently joined could get involved. So fortunately, that worked out. And then the diamonds, let's see what's going on there. But even the blue chips, really, you can see they're approaching that level. And so I do think the potential exists for very serious selling to finally occur. But unfortunately, it's harder, right, than we would want it to be. When we got to this juncture, I thought this would have happened a little sooner than it has. And since it didn't happen sooner, now I think things really are close to tilting in the bulls' favor. So what I mean by that is the seasonality starts to help them out a little bit in the third year of the cycle that's been tracking pretty good this year. Powell chilling out this meeting in about 11 days, 12 days from now, something like that. That could help them because as a cover story, these EPS reactions could help them that are largely, I think, engineered, but being able to move the big dogs back up with force and really malice, that will help obviously the indices in a big way. So it's a tougher juncture than I expected it to be. If we would have gotten here, in, let's say, the beginning of October, I would have said I probably would have just rolled all of the stuff that I was short this week and held it all, right? I probably would have overrolled all of it and stayed in the full thing because I would expect there to be a breakdown. But because they don't have, from what I could tell, they don't have a lot upcoming that they could hang their hat on as a cover story. But unfortunately, the cover stories are right around the next bend for them. And that's why we've got to be careful. So again, I've been preaching it. Everybody hates when I keep saying things, but I just learned the hard way. So I try to help anyone out that's new, but you've got to be really disciplined with what you're doing and keep the DDA going. Pete says it for a reason. We all say it for a reason. It's just because there are times when you get the super strong moves that if you could hold on longer, but until you really know that you're in that phase, they are really great at playing games, and it's a lot harder for them to really steal the money that you earn back from you if you stay disciplined, day in, day out, phase in, phase out. So I just want to end on that note. So I'm just going to say that sorry that I can't record it, but got the family up in the Blue Ridge Mountains, being able to see my daughters who were both away at school, one in SC, one in NC, and we're able to meet up here and get together during a nice time of the year up near Asheville and stuff like that. So won't be able to record on Sunday, so I had to record here. And so we're a little hobbled because I don't have my full setup, but hopefully this worked out. And I do hope that something that we covered in this video helps you out in this upcoming week or some week in the future. And I want to thank everyone for tuning in. And so everyone have a great weekend, or by the time you watch this, maybe hope you did have a great weekend, and get prepared, get your game face on for next week, because I think we're all going to need it. Thanks again.